That's the two big patterns to take away is if you can remove volatility, go back to the way it was for that. As I mentioned last week, there was a very, very nice strategy that was kind of mean reverting. And I think what is important, because mean reverting is not working as well, because I'm finding with the mean reverting, the volatility is really, really killing off that traditional way of trading off of mean reversion. So in order to make it more predictable, you have to remove as many exogenous dependencies as possible, meaning, as an example, if you have currencies you're going to try to trade or something else, like Bitcoin as another example, there's always going to be an event that will happen that will affect the price direction of, let's say, Bitcoin. So the more you remove from that, the better. So as I said, with the strategy that I love to be able to trade is the arbitrage between USDC, which is Circle stablecoin, and Tether. That removes all of the dependencies at all. So that kind of mean reverting works well, like really well. It's still my number one strategy that I've seen that works well. So that's the two big patterns to take away is if you can remove volatility, go back to the way it was. And the other thing is you want to have as few dependencies as possible, that where it's exogenous, external, an event that will affect the price direction. And a lot of the assets right now are being affected by what's going on in the market because of the unpredictable things that are happening in the economy and this war thing. So that's the problem. So the more you can get rid of that, the better. But there's very, very few patterns you can use to get what you want to have that consistent profit, if that makes sense.